So joining us to discuss the ECB report is Daniel Lacalle. He's the chief economist with the Tresses Hedge Fund, helping manage $6 billion of assets there. Also the author of Escape from the Central Bank Trap. Daniel, pleasure to see you. Thanks for coming on.
Thanks for having me.
Daniel, I want to bring your attention to one part of the ECB report that stuck out to me. They noted that stretched asset valuations are at risk of a disorderly correction. Now, looking at the markets and looking at the report, what do you think the ECB is worried about, which particular assets, and how significant could the correction be?
I think that what the ECB is saying is that they see, for example, that housing, cryptocurrencies, equity valuations, high-yield bonds. I think that they basically are warning about a very optimistic and exuberant level in many of the risky assets, particularly on the most illiquid and in the most volatile. No? The level of the correction is not necessarily explained. They simply warn about elevated valuations and excessive risk-taking. However, what I find interesting is that they don't mention the massively high valuation of sovereign bonds, because the reason why all those assets that they warn about have such high valuations is precisely because the ECB is making the allegedly safest asset, sovereign bonds, monstrously expensive by purchasing 100% of net issuances in the Eurozone. So the interesting thing about the report is that they are warning about something which is a direct consequence of quantitative easing, loose monetary policy, and low rates.
Because this is something we spoke of as a long time ago, I believe, near the beginning of the pandemic when they embarked on this ultra low rate environment. You said it was going to push up the price of riskier assets where we have money managers and other investors trying to find return, trying to find yield and putting them into these riskier assets. It's a self-fulfilling prophecy, right?
Absolutely. Think about this. If you look today at the bond yields in nominal and real terms of all of the Eurozone countries, from Greece to Portugal, Spain, Italy, the riskier ones, the most indebted ones, no problem whatsoever, all of those sovereign bonds are trading at negative real and nominal yields in some cases. No? The problem that I find is the following. The ECB is warning about excessive risk-taking, and that's a good thing. But at the same time, they're not letting any other option for investors, because for investors, as you said, to reach a certain level of yield, they need to look for very aggressive and very risky assets. If you don't find yield in sovereign bonds, you need to find some yield in almost bankrupt high yield bonds that are not high yield even anymore. So this financial repression is leading to excessive risk taking.
Because you mentioned not doing anything about it. We have the Federal Reserve here to combat inflation, all but saying it. They've begun tapering their asset purchases, tapering their bond purchases. ECB, I believe, has no intention, at least no plan to do it in the immediate term, right?
The ECB is probably not going to start the tapering process anytime soon, because there are a number of Eurozone economies that would not be able to tolerate it, because the level of deficit spending of some of the countries is so incredibly high that if even a small proportion of the bonds that they issue was to go to the secondary market, it would cause a very significant increase in bond yields that they would have problems with. So either the central bank continues to purchase all of the bonds, or there's going to be the risk of a crisis, because there's such a disparity between the level of risk that Eurozone governments are taking and the yields at which they're borrowing, that it's virtually impossible to talk about tapering without creating a significant tantrum.
So who is this warning for, right? If this is the fundamental problem, is the low interest rates, and they can't afford to allow the interest rates to rise, who are they warning?
I find it. I mean, I find it interesting from a principle perspective, from simply just an anecdote of an analysis from the ECB. I think it is interesting, and I concur. I agree that valuations are very aggressive, but I find absolutely no mention in the ECB's analysis of the direct consequence of massive quantitative easing and low rates for this exuberance. No, so they're probably warning small investors. They're probably warning retail investors that might be thinking about purchasing at all-time highs. Maybe, but ultimately, those same retail investors, if they try to put some money into sovereign bonds, they're going to get negative yields. So therefore, they don't have much option.
So let's think about money managers in the Eurozone. I believe here as well, although the Fed hasn't come out with a similar report just yet. So I'm investing in these riskier assets. I can't find yield where I used to find yield in the safer bonds, okay? How much of a worry are rising prices and inflation? Why do they worry me?
Well, rising prices should worry investors, mainly because it's not good when you have a low growth, high unemployment area like the Eurozone with rising prices and inflation. That's bad. Stagflation is dreadful for risky assets in general. No? So as an investor, that's not a good thing. No? However, it seems that most of the market is buying the central bank theory of transitory inflation, but not because they don't see inflation rising, but because they believe that the central bank, particularly the European Central Bank, and it's very evident in the value of the euro relative to the dollar, will maintain a very aggressive and loose monetary policy despite inflation.
I see, but the flip side is these high, even the ECB is admitting the flip side is these what they would call extended valuations, as you would call them, aggressive valuations. So how does it end?
Well, there's only one way in which you sort of make markets be a little bit more based on fundamentals and less on whatever the central bank is going to do, is by doing less. It makes no sense, in my opinion, from the central bank perspective, to say that we have a robust recovery, that there's going to be strong job growth, strong investment growth, and strong GDP growth, and at the same time keep purchasing 100% of the net issuances of sovereigns and maintaining negative real rates. Makes absolutely no sense to me. So ultimately, it's in the hands of the central bank, and if the central bank doesn't act accordingly, the end game is that there will be some form of very aggressive correction or a very aggressive impact of financial assets in the real economy.
Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.